What's interesting about the really big bubbles in history is that they rarely look like bubbles while you're living through them. In 1999, I sat in Omaha watching internet stocks double every month. People told me I was too old, that I didn't understand the new economy. Then the NASDAQ lost 80% of its value. Trillions evaporated. Now Goldman Sachs just published something that should make every investor pause. Since ChatGPT launched, AI-related stocks have gained $19 trillion in market value. That's more than China's entire GDP. And according to Goldman's analysis, we've already priced in every conceivable benefit AI could deliver over the next decade. The upper limit, the ceiling. In my 94 years, I've learned something. When the market prices in perfection, it rarely delivers perfection. This affects your 401k, your job security, every tech stock you own. And if you're thinking this sounds familiar, that's exactly what we need to talk about. Here's the situation in one sentence. The stock market has already paid for AI's promise, all of it, before most companies have figured out how to make money from it. Think of it like this. You're a farmer and someone invents a revolutionary seed that'll supposedly triple your harvest. So you mortgage everything, farm, equipment, cattle, to buy this seed at the highest price anyone's ever paid. You're not betting on what the seed has done. You're betting on what it might do if everything goes perfectly. That's what happened here. $19 trillion poured into companies based on what AI might achieve. Now AI is real. The technology works. Companies are using it to cut costs and improve products. I'm not a skeptic about the technology itself, but I am a skeptic about paying full price for uncertain futures. Bank of America surveyed hundreds of professional fund managers. 45% identified an AI bubble as the single biggest risk in today's market. Not inflation, not recession, an AI bubble. Think about that. The people who've made billions on this rally, who have every incentive to stay optimistic, half of them are looking at the exit. $19 trillion in market cap gains since November 2022. NVIDIA alone added over $1 trillion this year, reporting $57 billion in quarterly revenue. That's real money, real business. But here's where it gets interesting. Goldman Sachs calculated how much economic value AI would need to create to justify these stock prices. They modeled capital spending, productivity gains, cost savings, new revenues. Their conclusion, $8 trillion in real economic impact over the next decade. Best case scenario. The market has priced in $19 trillion. That $8 trillion isn't guaranteed. It's the ceiling. The best possible outcome if AI delivers everything its most optimistic promoters believe. Meanwhile, $19 trillion is already sitting in stock prices today. You're paying for the best possible outcome before you know if you'll get it. Let me explain something most people don't understand about technology investing. The fact that something transforms the world does not mean it makes you money. The telephone transformed the world. Most telephone companies went bankrupt. The automobile transformed the world. Hundreds of car companies in 1920. How many today? The airplane transformed the world. The airline industry has destroyed more capital than it's created over its entire history. Warren Buffett, famously said someone should have shot down the Wright brothers at Kitty Hawk. Would have saved investors a fortune. The internet transformed the world. Yes, Amazon and Google made people rich. But for every Amazon, there were 100 pets.coms that raised billions, burned through cash, and disappeared. Webvan, eToys, Cosmo.com, the list goes on. When someone tells you AI will change everything, therefore buy AI stocks, they're confusing transformation with investment returns. They're making a logical leap that doesn't hold up. In 1999, I refused to buy internet stocks. Fortune magazine ran covers questioning if I'd lost my edge. Investors called me a dinosaur. Tech CEOs who'd never turned a profit got magazine covers. Meanwhile, I sat in Omaha buying boring businesses at reasonable prices. Then the NASDAQ fell from 5,000 to 1,100. 80% gone. Here's the distinction that nobody wanted to hear then and nobody wants to hear now. The internet skeptics were wrong. E-commerce did revolutionize retail. Digital advertising did destroy newspapers. Cloud computing did transform enterprise IT. The transformation was absolutely real, but most stock prices were absolute fantasy. That matters today because we're making the exact same mistake. NVIDIA trades at 70 times earnings, maybe more by the time you watch this. You're paying $70 for every $1 of profit the company makes this year. You're not buying NVIDIA based on what it does today. You're buying it based on what you hope it does for the next decade. And here's what makes this terrifying. That valuation assumes NVIDIA maintains its technology advantage forever, that no competitor catches up, that Microsoft doesn't build better chips. They're already trying. That Google's TPUs don't improve. They're already improving. That AMD doesn't close the gap. They're already closing it. That some startup in a garage doesn't figure out a completely different approach that makes today's chips obsolete. In other words, you're betting on a permanent moat in technology, a sector where technological moats last on average 3 to 5 years. And it's not just NVIDIA. Look at any company that announced AI initiatives this past year. Stocks jumped 20, 30, even 50%. Not because revenue increased, not because profits grew, not because anything fundamental changed about the business, because they said artificial intelligence in a press release. That's not investing. That's not even speculation. That's paying for a story instead of paying for assets. That's paying for hope instead of paying for cash flow. That's paying for narrative instead of paying for earnings. And stories, hope, and narratives are expensive, very expensive. If you own an S&P 500 index fund, and you should, that's smart long-term investing, you already own massive AI exposure. 6 companies dominate the index: Apple, Microsoft, Alphabet, Amazon, NVIDIA, and Meta. Together, they represent over 30% of the entire S&P 500. Every one of them is betting billions, tens of billions, on AI infrastructure. So when AI stocks go up, your index fund goes up. Great. But when AI stocks fall, and eventually they will fall from these levels, your index fund will feel it hard. That's not a prediction about next week or next month. It's a statement about mathematics. What goes up this much, this fast, on this much speculation, eventually comes down. Sometimes slowly and orderly, sometimes very quickly and violently, but it always comes down. Now I know what you're thinking, But Warren, you own Apple. That's a tech company. That's an AI company. Fair question, and it shows you're paying attention. Yes, Berkshire owns a lot of Apple. Used to be even more. We've been selling some. But here's the difference, and this is crucial to understand. When I bought Apple, I wasn't buying AI promises. I wasn't buying potential. I wasn't buying a story about what might happen someday if everything goes right. I was buying a cash-generating machine. Apple produces $40 billion in free cash flow every quarter. $40 billion. They print money. They return that cash to shareholders through dividends and buybacks. They have 1 billion customers locked into an ecosystem that would be painful to leave. Apple happens to be adding AI features to their products. Siri's getting better. Their chips are getting faster. They're integrating AI into photos, messages, productivity apps. That's great. Might make the products better. Might increase customer satisfaction. Might even drive some additional sales. But I'm not paying for that possibility. I'm paying for a business that works spectacularly well today. The AI upside is free, a bonus, optionality. That's completely different from paying 70 times earnings, betting that AI works out perfectly and changes everything. Here's another angle. If you run a business that needs AI infrastructure, you're trying to plan capital expenditures for the next 5 years. You're trying to budget. You're trying to make rational, defensible decisions that you can explain to your board, your investors, your employees. 6 months ago, you thought you understood the landscape. You knew what NVIDIA chips cost. You knew what data center capacity cost. You knew what AI talent cost. Expensive, but quantifiable. You could build a financial model, run sensitivity analyses, make decisions. Today, the ground shifts under your feet every month. Chip prices are rising. Data center capacity is constrained. Talent costs have exploded. Good AI engineers now command $500,000, $1 million in total compensation. Technologies you invested in 6 months ago might be obsolete by the technologies announced next quarter. And you have absolutely no idea whether the AI tools you're deploying today will even work with the AI platforms that exist in 2 years. Will they integrate? Will they scale? Will something better come along that makes your investment worthless? That's the real cost of this mania that nobody talks about. Not just stocks being overvalued, though they are, but real businesses facing real uncertainty, real planning problems, real capital being misallocated to projects that might never pay off. And when capital gets misallocated on this scale, economies suffer, innovation suffers, productivity suffers, all the things we actually care about when we strip away the financial engineering. If you're trying to value companies right now, this situation just added massive uncertainty to your calculations. Let me show you what I mean. Take a regular company, not an AI company, just a normal business, a regional bank, a retail chain, an industrial manufacturer. 6 months ago, you valued it at 10 times earnings based on stable cash flows and predictable growth. Standard valuation, nothing fancy. Yesterday, you had it modeled out. 10 times earnings, 3% growth, decent dividend. You understood the business. You knew what you owned. Today, that same company announces AI initiatives. Maybe they're using AI to improve customer service. Maybe they're optimizing inventory with machine learning. Maybe they're experimenting with AI-powered analytics. Doesn't matter what specifically. Their stock jumps 20%. Did the fundamentals change? Not yet. Nothing about their actual business operations changed overnight. But the story changed. The narrative changed. The hope changed. Tomorrow, now you have to model multiple scenarios. Maybe AI cuts their operating costs by 30% over 3 years, and margins explode from 15% to 20%. Maybe they waste $20 million on consultants and see zero benefit. Maybe their competitor implements AI better and steals market share. Maybe the technology doesn't work in their specific industry. Every one of those scenarios produces radically different financial outcomes, different cash flows, different multiples, different intrinsic values. And right now, the market is pricing in the best scenario for everyone simultaneously. Every company cutting costs 30%, improving margins, gaining competitive advantage, all at once, which is mathematically impossible. Here's something I've learned over decades of doing this. Uncertainty has a cost. When you can't agree on what something is worth, when possible scenarios range from terrible to spectacular, rational investors demand a discount. They want compensation for taking on that uncertainty. That's margin of safety. That's prudent investing. But that's not what's happening today. Instead of demanding discounts, investors are paying premiums. They're paying for maximum optimism at maximum prices. They're pricing in perfection across the entire market. That can work for a while. I've seen it work for years sometimes. Momentum can carry stocks higher even when valuations are absurd. Greater fool theory. Someone will pay more tomorrow than you paid today. But eventually reality shows up. Earnings reports come out. Revenue numbers materialize. Profit margins reveal themselves. Companies either deliver on the AI promises or they don't. And when reality is less exciting than the story, which it usually is, prices adjust. Sometimes gradually, sometimes violently. Let me be frank about something. I can't tell you when this adjustment happens. Could be next month, could be next year, could be 3 years from now. Anyone who claims to know is lying or delusional. Market timing is a fool's game. I don't do it. You shouldn't either. But I can tell you with certainty, prices this high, based on expectations this optimistic, with uncertainty this extreme, leaves zero room for disappointment. And disappointment, in my experience, is the most reliable thing in investing. This isn't just about investors making or losing money. That happens every day. Markets go up, markets go down, people win, people lose. That's capitalism. This is about capital allocation on a massive economy-wide scale. $19 trillion. Let me put that in perspective. That's enough money to rebuild every bridge, road, and water system in America. Twice. It could fund cancer research for 30 years, build affordable housing for 10 million families, finance the entire energy transition everyone talks about. Instead, it's bidding up stock prices based on maybes and hopefullys and wouldn't it be greats. Now that's not about politics. That's not about morality. It's about economic efficiency. It's about whether capital is flowing to its most productive uses, whether resources are being allocated to create actual value or just to chase stories. And right now, looking at these valuations with clear eyes, I'd argue capital is not being deployed efficiently. When money chases stories instead of earnings, when prices reflect hope instead of reality, real consequences follow. Companies that shouldn't get funded raise billions because they have AI in their pitch deck. Meanwhile, companies solving real problems get ignored because they're not sexy AI plays. Startups burn through cash trying to build AI products nobody needs. Established companies waste billions on AI transformation initiatives that go nowhere. Talent gets misallocated. Brilliant engineers working on marginal improvements to chatbots instead of solving hard problems in energy, healthcare, infrastructure. That matters for everyone, not just for investors, for the real economy, for innovation, for productivity, for actual wealth creation. Here's what I've learned in 7 decades of watching markets work and fail. The times of maximum danger aren't when everyone's worried. Fear keeps you honest. Fear makes you careful. Maximum danger comes when everyone's convinced they can't lose, when skepticism gets laughed out of the room, when pointing out risk gets you called a dinosaur. In 2007, everyone knew real estate only went up. Banks were lending to anyone with a pulse. Wall Street was packaging those loans into securities rated AAA. People were buying houses they couldn't afford with loans they didn't understand because prices only went up. Anyone who questioned this got dismissed. You don't understand the new mortgage products. Housing has never gone down nationally. This time is different. We remember how that ended. 8 million jobs lost, 10 million foreclosures, global financial crisis, trillions in wealth destroyed. Right now we have something similar brewing. Not identical. This isn't a housing bubble. The mechanics are different. But the psychology is identical. The certainty is the same. The conviction that this time is different, that old rules don't apply, that skeptics don't understand. That's always, always when you need to be most careful. This is about human nature, about crowd behavior, about the eternal cycle of greed and fear that drives every bubble, every crash, every market cycle in history. Regardless of your politics, regardless of whether you love AI or fear it, you should want capital markets that work efficiently. You should want prices that reflect reality. You should want businesses valued on their actual contributions to society, not on narrative and hype and hope. Because when markets lose touch with reality, when prices become detached from value, everyone pays the price eventually. Not just the speculators who bought at the top. Everyone. Through job losses, through pension losses, through reduced innovation, through wasted capital that could have built something real. Let me take you back to 1962. I was 31. Managing money for friends and family. The market dropped 28%. Kennedy fighting steel companies, Cuba crisis, uncertainty everywhere. One investor, a doctor, called me panicking. His account was down 20%, wanted to sell everything. I explained, nothing about our businesses had changed. We were buying more at cheaper prices. This was opportunity, not disaster. He sold anyway, couldn't handle volatility, locked in his losses. 3 years later, if he'd held on, he'd have doubled his money. Instead, he never came back. That lesson taught me something worth more than any profit. The biggest risk in investing isn't being wrong about facts. It's being unable to handle your emotions when prices move against you. Fast forward to 1999. Different market, same lesson. Brilliant people convinced themselves old rules didn't apply. I refused to play. Berkshire underperformed. Shareholders got frustrated. Media wrote us off. Then 2000 hit. Those lessons from 1962 prove themselves again. Patience pays. Discipline matters. Price is what you pay. Value is what you get. Human nature hasn't changed. Greed and fear still drive markets. Hope makes people pay too much. Panic makes them sell too cheap. The technologies change. The stories change. But the patterns are eternal. If you're still reading, you're probably wondering, okay, but what does this mean for me specifically? What should I actually do? Fair question. Let me break this down by who you are and what you're dealing with. If you're a business owner or executive, stop trying to figure out if you're behind on AI. Everyone feels behind right now. Everyone's confused. Everyone's scrambling to figure out what AI means for their industry, their company, their competitive position. That feeling of uncertainty, that's not a signal that you're doing something wrong. That's a signal that we're in a speculative phase where nobody actually knows what anything is worth or what works. Here's what to do. Focus on your core business. Focus on what you know. Focus on serving your customers better, operating more efficiently, building competitive advantages that don't depend on the latest technology. If AI tools genuinely improve your operations at reasonable cost, and some do, then use them. But don't blow up your entire business model chasing a trend just because competitors claim they're doing it. Half of them are bluffing. The other half are wasting money on consultants. I've seen this pattern for 70 years. Companies panic about being left behind, spend massive amounts on the latest thing, see no return, then quietly write off those investments 5 years later. Don't be that company. If you're an investor, be brutally honest with yourself about what you own and why you own it. If you bought NVIDIA 2 years ago at reasonable prices, congratulations, you made a great call. You bought a real business before everyone else figured it out. But if you're buying NVIDIA today at 70 times earnings or any AI stock at similar valuations, understand what you're doing. You're not investing based on fundamentals. You're speculating on continued momentum. You're hoping someone will pay more tomorrow than you're paying today. Nothing inherently wrong with speculation. I've done it myself occasionally. But call it what it is. Don't confuse it with investment. Don't bet the farm on it. Don't put money in that you can't afford to lose completely. And for God's sake, don't convince yourself it's safe because the stock went up yesterday. That's not analysis. That's rationalization. If you own index funds, which I recommend for most people, understand your exposure. Run the numbers. The S&P 500 is now 30% concentrated in 6 companies, all of them massively exposed to AI valuations. When those valuations correct, your index will feel it proportionally. That doesn't mean panic and sell everything. That's almost always the wrong move. But it does mean understand your risk. Maybe rebalance slightly toward value stocks that aren't priced for perfection. Maybe look at international stocks where valuations are more reasonable. Maybe hold a little more cash than usual so you have firepower when prices become more attractive. Most importantly, be mentally prepared for volatility. Not if, when. These valuations will not hold. They never do. Prepare yourself emotionally now so you don't panic and sell at the bottom. If you're an employee in the tech sector, the golden age of unlimited budgets and crazy compensation packages won't last forever. I've watched this cycle multiple times. In 1999, tech companies paid insane salaries and gave massive stock options because they were competing for talent with unlimited venture capital backing them. Then March 2000 hit. The NASDAQ crashed. Suddenly, companies cared about profitability again, about sustainable business models, about cash flow. Layoffs came fast. Stock options became worthless. People who'd been making $300,000 with stock options were suddenly unemployed. I'm not predicting imminent layoffs. Maybe AI proves profitable enough to sustain current spending levels. Maybe. But I am saying, be smart. Save aggressively. Don't assume your $400,000 total compensation package is guaranteed for the next decade. Don't buy the expensive house, assuming your income only goes up. Build a cushion. Have 6 months, ideally a year, of expenses saved. Max out your 401k. Put money in boring index funds, not more company stock. Be ready. When the market corrects, companies that are actually profitable and well managed will be fine. Companies burning cash, hoping to achieve scale, will not. Know which one you work for. If you're just a person trying to manage their finances and future, don't panic, but don't be complacent either. Your retirement account probably has significant AI exposure if you own any broad market index funds. That's not automatically bad. Diversification is still wise. But understand what you own. Look at your asset allocation. Make sure you're not over-concentrated in U.S. large-cap growth stocks. Have some bonds. Have some international exposure. Have some value stocks. Have some cash. And most importantly, don't make emotional decisions. Don't sell everything because you read one article about a bubble. But also don't assume everything will keep going up forever because it has for the past 2 years. Have a plan. Stick to the plan. Rebalance periodically. Ignore the noise. That's how you build wealth over decades. Next few months, more of the same. AI stocks stay elevated, possibly higher. Momentum continues. By mid-2026, reality starts mattering. Earnings reports show who actually benefited from AI and who wasted money. Some disappointments become apparent. By late 2026 or 2027, probably a correction. Some stocks cut in half. Others hold up. Differentiation happens. 3 scenarios. Scenario A, 20% probability. AI delivers so much value so quickly that these valuations prove justified. The bulls were right. Scenario B, 60% probability. AI delivers some value, but not enough to justify current prices. Stocks correct 30 to 50%. Some winners, lots of losers. Scenario C, 20% probability. AI proves overhyped. Benefits take much longer to materialize. Serious crash, 60 to 80% declines. 2000 style correction. I don't know which we get. Neither does anyone else. But I'd rather be approximately right than precisely wrong. And paying peak prices for maximum optimism seems precisely wrong. We live in an era of hot takes and breathless headlines. Every story gets spun as disaster or triumph. Nuance gets lost. But the truth is straightforward. AI is real technology with real value. 19 trillion in gains prices in more than AI will likely deliver. That gap will close. Either AI over-delivers or stocks reprice. Most likely, stocks reprice. People who bought at peak prices will feel pain. Not a crisis, just markets returning to reality. If there's one thing to take away, the quality you need most as an investor isn't intelligence or information, it's temperament. The ability to watch everyone else get rich on something you don't understand and still stick to your principles. To be patient when patience isn't rewarded. To be greedy when others are fearful, and fearful when others are greedy. Short term, messy. Stocks might go higher. Momentum might continue. People buying today might make money for months or years. But long term is about whether prices reflect reality. Whether businesses get valued on contributions or narratives. Based on history, based on human nature, based on every bubble I've seen in 7 decades, I'd bet on reality eventually winning. The markets are working. Capital is flowing to AI companies. Entrepreneurs are innovating. That's all good. But prices are detached from value, and that always corrects. Maybe slowly, maybe suddenly, but always. The market is not a casino. It's a weighing machine. In the short run, it's a voting machine responding to enthusiasm and fear. But long run, it weighs, it measures, it values. When the weighing happens, 19 trillion in gains built on 8 trillion in value won't hold up. That's the real story. Beyond the hype, beyond new highs, beyond fear of missing out. The market will figure this out. It always does. And that's worth more than most people realize.